Most people think retiring in the UK is simple. You work hard your whole life, you hit 66, and the money just starts flowing in. State pension, maybe a workplace pension on top, a bit of savings, and you are sorted. But here is the thing nobody talks about. Where you actually live in retirement could be silently costing you thousands of pounds every single year, and HMRC and the Department for Work and Pensions are perfectly happy for you to never find out. Today we're going into the 3 specific parts of the United Kingdom where retirees are losing money every year, often without even realizing it. And when I say losing money, I do not mean losing it on a bad investment or spending too much at Tesco. I mean money that is legally yours, money the government owes you, money that could cover your heating bills, your food shop, your holidays, your grandkids' birthday presents. Money that is just sitting there unclaimed because nobody told you how to get it. This is not a scare story. By the end of this video, you will know exactly what is going on, why it is happening, and most importantly, what you can do to stop being one of the people who misses out. Let us get into it. Before we name the 3 areas, you need to understand something that most people completely skip over when they think about retirement income in the UK. There are actually multiple layers to what you are entitled to receive, and the mistake most people make is only ever thinking about one of them. They know about the state pension, some of them know about their workplace pension, but below that, sitting almost invisibly, is an entire second tier of financial support that could be worth more money to you than you might expect. That second tier is called pension credit. And this is where this whole conversation starts. Pension credit is a means-tested benefit from the government designed to top up the income of pensioners who are not receiving enough to live on. Right now, if you are a single person in retirement and your weekly income falls below around £238, or if you are a couple and your combined weekly income falls below around £363, you could be entitled to pension credit. That is the government essentially saying we will top up whatever you have to make sure you are not going without. Now here is where it gets interesting. Pension credit is not just a bit of extra cash. When you claim pension credit, it unlocks a whole stack of other benefits on top. We are talking housing benefit if you rent. We are talking help with council tax, cold weather payments when temperatures drop, help with NHS dental treatment, glasses and hospital travel costs, the warm home discount on your energy bills, and until recently, the winter fuel payment as well. In other words, pension credit is a key. It opens doors to support that can, in total, be worth thousands of pounds a year on top of the headline payment itself. So what is the problem? The problem is that somewhere around 900,000 pensioner households across the UK who are entitled to pension credit are not claiming it. Nearly 1 million people leaving money on the table. The average unclaimed amount, according to research, is around £4,300 a year per household. And if you factor in all the other benefits that pension credit unlocks, Age UK found that the average person who they helped successfully claim was missing out on nearly £5,900 a year. That is almost £5,000 every single year, sitting there, unclaimed. Now, you might be wondering, why would anyone not claim money they are entitled to? And this is actually a really important question, because the answers tell you a lot about why this problem has not been fixed. Some people do not know it exists. Simple as that. They have never heard of pension credit. They just assume retirement income is whatever their state pension pays them, plus whatever they saved. Nobody told them there was a top-up available. Some people think they will not qualify because they have some savings or a small private pension, but that is often a misunderstanding of how the rules actually work. Having savings does not automatically disqualify you. Having a small additional pension does not automatically disqualify you. The eligibility rules are more nuanced than people assume, and plenty of people who believe they are not entitled actually are. And some people, particularly older generations, feel a sense of pride that stops them from claiming. They do not want to feel like they are taking something. They worked all their lives, they paid their national insurance, and asking for help feels like crossing a line they were brought up never to cross. But here is the brutal truth about that mindset. Pension credit is not charity. It is not a handout. It is a benefit built into the system specifically for people in retirement who need their income topped up. You paid into this system for decades. This money is part of the deal. Not claiming it does not make you independent. It makes you poorer. Right. So now let us talk about the 3 parts of the UK where this problem is hitting hardest and why the specific situation in each one is slightly different. The first one is Scotland. Now, Scotland has its own story when it comes to retirement and money, and it splits into 2 separate issues. One of them is about pension credit and benefits. The other is about income tax, and the combination of the 2 means Scottish retirees are in a uniquely tricky position. Let us start with the income tax side, because this one trips people up all the time. Since 2017, the Scottish Parliament has had the power to set its own income tax rates. So if you live in Scotland, you pay Scottish income tax, not the standard UK rate. And the Scottish system is more complicated. Where England, Wales, and Northern Ireland have 3 income tax bands, Scotland has 6. There is a starter rate of 19%, a basic rate of 20%, an intermediate rate of 21%, a higher rate of 42%, an advanced rate of 45%, and a top rate of 48%. Now you might be thinking, so what? I am retired, my income is not massive, why does this affect me? And this is where people get caught out. Your pension income, whether that is your state pension, a private pension, a workplace pension, or a defined benefit scheme, all of that counts as income for tax purposes in Scotland under the Scottish system. And once your total retirement income gets above a certain level, you are paying Scottish tax rates, not the UK-wide ones. And above roughly £43,000 in annual income, Scotland's higher rate kicks in at 42% compared to 40% in England. That might not sound like a massive difference, but on an income of £50,000 a year, the calculation shows Scottish taxpayers paying roughly £1,500 more in income tax than someone with identical income living in England. And here is the part that genuinely matters to a lot of retirees. If you move to Scotland in retirement, maybe to be closer to family, maybe because you love the place, maybe because house prices outside the major English cities were doing your head in, HMRC needs to know. Your tax code changes when you move to Scotland. It starts with an S. If you do not notify HMRC about your change of address, you could end up on the wrong tax code, paying the wrong amount, and creating a mess that takes years to sort out. People in this situation often do not realize their tax code is wrong until HMRC sends them a bill for underpaid tax, or in some cases, they have been overpaying and need to claim a refund. But here is the flip side for lower income Scottish retirees, and this is important. If your total retirement income is below roughly £33,500, Scotland's system actually works in your favour compared to England. The starter rate at 19% is a penny cheaper in the pound than England's standard 20% basic rate. So for people on modest pensions, Scotland can be marginally better. The problem is that many of those same lower-income Scottish retirees are also the ones most likely to be entitled to pension credit, and also the ones most likely to not be claiming it. Now here is the second layer of the Scottish story, and this one changed significantly in recent years. The winter fuel payment. For decades, the winter fuel payment was paid automatically to most pensioners. It was worth between £150 and £300 per year to help cover heating costs in winter. Then in the summer of 2024, the government announced it was restricting eligibility in England and Wales to only those receiving pension credit or other qualifying benefits. Scotland handled it differently. The Scottish government created its own version called the Pension Age Winter Heating Payment, and initially that too was linked to pension credit eligibility. What this means in practice is that in Scotland, just like in England and Wales, if you are a pensioner who is entitled to but not claiming pension credit, you lose access to the winter heating support as well. 2 losses stacking on top of each other. And because Scotland has a significant proportion of pensioners in rural and remote areas where heating costs can be higher, this hits particularly hard. The second area is Wales. Wales has a slightly different story, but the core of it is the same. Pension credit is going massively unclaimed, and the reasons in Wales have some local colour to them that is worth understanding. Wales has some of the highest levels of pension poverty in the UK. Parts of the South Wales valleys, parts of Mid Wales, many former industrial and mining communities. These are areas where people have spent their working lives in physical jobs, often with relatively modest earnings, and are now in retirement with lower pensions as a result. Exactly the demographic you would expect pension credit to be reaching. And yet take-up rates remain stubbornly low. Some of this is about digital access. A lot of older pensioners in Wales, particularly in rural areas, are not online. The easiest way to check if you qualify for pension credit is through the government's official benefits calculator on gov.uk. But if you do not have reliable broadband, if you are not comfortable on a computer, or if you simply do not know the tool exists, that route is closed to you. Some of it is also about language. Wales is a bilingual country. Welsh language services exist for pension credit and other benefits, but awareness of those services and confidence in navigating them is not uniform across the country. There are Welsh-speaking communities, particularly in the north and west of Wales, where older people may be more comfortable getting information in Welsh, and where gaps in outreach have historically been bigger. And some of it is just about the complexity of the system. Pension credit is, in all honesty, not the simplest benefit to understand. The rules around savings, the treatment of additional pension income, the interaction with housing benefit, none of it is immediately obvious. In areas where access to free benefits advice is limited, people simply do not claim because they are not sure where to start and they do not want to get it wrong. Wales also has its own council tax reduction scheme, its own help with heating costs under the warm home discount, and its own NHS support for pensioners. But all of those things have their own eligibility criteria, their own application processes, and their own quirks. Navigating all of that without help is genuinely difficult for a lot of people, and the cost of not navigating it is, on average, thousands of pounds a year. The third area is Northern Ireland. Northern Ireland is in some ways the most complicated of the three because it operates under a slightly different administrative system. The Department for Communities in Northern Ireland runs benefits there rather than the DWP in London. In practice, the rules are broadly similar, but there are differences in how things are administered, how and when rates are updated, and what local support looks like. The pension credit issue exists in Northern Ireland just as it does everywhere else. Eligible pensioners are not claiming, but Northern Ireland also has some additional layers that create their own challenges. First, Northern Ireland has its own distinct approach to social care and support for older people, and the interaction between that and pension entitlements can be confusing. If you are a pensioner in Northern Ireland who has care needs or who cares for someone else, the benefits picture is more complex and the risk of leaving money unclaimed is higher. Second, Northern Ireland has historically had challenges around poverty and deprivation that have affected retirement outcomes. Pensioners who spent their working lives in sectors that were economically depressed or who had interrupted work histories for a range of reasons can end up with patchy national insurance records, which affects their state pension entitlement. A lower state pension means a higher chance of qualifying for pension credit, but the same circumstances that led to a lower pension often also mean less access to the advice and support needed to claim the credit. Third, there is the inheritance tax and estate planning piece. Northern Ireland has a significant rural property base. People who might look like they are comfortably off because they own land or a house could actually have a very low income in retirement. The assets they have are locked up in property, they do not convert easily into cash, and yet the value of those assets can create a misleading picture that makes people think they would not qualify for any means-tested support. That assumption is often wrong, and it stops people from even checking. Now let us zoom back out and talk about what you can actually do with all of this information, because the whole point of this channel is not just to give you a problem, it is to show you what to do about it. If you are in retirement right now, or approaching retirement, here is the checklist that you need to work through. First, and most importantly, check whether you are entitled to pension credit. Do not assume you are not, just check. You can do this through the government's pension credit calculator on gov.uk, or by calling the pension credit claim line on 0800 99 11234. It takes minutes, and if you are entitled, claiming backdates up to 3 months, meaning you could get a lump sum for the period before your claim was processed on top of the ongoing payments. If you are in Scotland, number 2 is to check your tax code. If your code starts with an S, that is correct for Scotland. If it does not, contact HMRC because something may have gone wrong, especially if you have recently moved. Getting your tax code wrong means you are either overpaying or underpaying, and neither of those is a situation you want to be in. You can check and manage your tax code through your personal tax account on the HMRC website. Number 3 applies to everyone. Check whether you have lost pension pots from previous jobs. This one is genuinely shocking. According to the Pensions Policy Institute, there are currently over 3 million unclaimed, lost or inactive pension pots in the UK, worth a combined total of over £31 billion. That is billions with a B, sitting in old workplace pension schemes from jobs people changed years ago and forgot about. The average lost pot is worth around £9,500, and for people in the 55 to 75 age bracket, it rises to over £13,000. There is a free government service called the Pension Tracing Service that can help you find old pensions. Again, it is on gov.uk. This is not a difficult thing to do, and the payoff could be massive. Number 4. If you receive pension credit or you qualify for it, make sure you are also claiming every benefit that it unlocks. That means housing benefit if you rent. That means council tax reduction. That means the warm home discount. That means attendance allowance if you have care needs. It means the winter fuel payment now that it has been extended again to all pensioners with income below £35,000. All of these things have their own claim processes, and just being on pension credit does not automatically enroll you in all of them. You have to actively claim most of them. Number 5. If you have savings in cash accounts outside of an ISA, check whether you are paying tax on the interest you do not need to. Basic rate taxpayers get a personal savings allowance of £1,000 a year in interest tax-free. If your savings interest is below that threshold, you should not be paying any tax on it. If you are, it might be because HMRC has your tax code set in a way that incorrectly taxes your savings income. You can get this corrected. Number 6. If you are in Scotland and you are a higher income retiree pulling income from a pension pot, salary sacrifice, or structuring your withdrawals carefully to stay below the higher rate threshold can save you meaningful amounts. The Scottish higher rate at 42% kicks in earlier than in England, at around £43,600 of income, rather than £50,270. If you can manage your drawdown to stay below that threshold, you are saving 2% on every pound above it compared to someone who is not paying attention. Now, before we wrap up, let us also address the elephant in the room. Why is so much money going unclaimed? Why does the government not just automatically pay people what they are entitled to? The honest answer is that the system was not designed with simplicity in mind. Pension credit alone is means tested, which means it requires an assessment of income and capital. Universal credit was supposed to eventually replace a lot of legacy benefits and simplify things, but pension credit sits outside of universal credit for most people over state pension age. So you end up with a patchwork of different schemes, different departments, different application processes, and different rules. HMRC handles your income tax. The DWP handles pension credit and most benefits in England and Scotland. The Department for Communities handles it in Northern Ireland. Local councils administer council tax reduction. Your pension provider handles your private pension. None of these talk to each other automatically, and none of them will proactively tell you what you are missing. That is the system. And until it changes, the only way to make sure you are getting everything you are entitled to is to know what to look for and go and find it. So here is the summary of everything we have covered today. Scotland, Wales, and Northern Ireland are the 3 areas of the UK where retirees face specific challenges that can cost them thousands of pounds a year. In Scotland, it is the combination of Scottish income tax rates that bite harder on middle and higher incomes in retirement, combined with the pension credit gap that leaves people missing out on the winter heating support and the wider benefits that pension credit unlocks. In Wales, it is about access and awareness, with a large population of pensioners in former industrial and rural communities who qualify for pension credit but are not claiming it, leaving an average of over £4,000 a year unclaimed per household. And in Northern Ireland, it is the combination of a separate administrative system, historically lower pension outcomes, and the complexity of navigating benefits alongside property wealth and care needs. But honestly, while those 3 areas have their own specific flavours of this problem, the core issue is UK-wide. 900,000 households across the whole country are leaving pension credit unclaimed. Over 3 million pension pots are sitting lost and forgotten. And hundreds of thousands of retirees are on incorrect tax codes or missing supplementary benefits they are fully entitled to. The difference between a comfortable retirement and a difficult one in many cases is not about how much you earned or how much you saved. It is about knowing the system and making sure you are claiming every penny you are owed. That is what this channel is here to help you do. If you found this video useful, share it with someone you know who is retired or getting close to it, because there is a real chance they are leaving money on the table right now and have no idea. Hit the like button, subscribe if you have not already, and if you want to know more about any of the specific topics we have covered today, drop your questions in the comments and we will cover them in future videos. We will see you in the next one.